Wales McClellan is BC's leading commercial, institutional, and industrial construction partner. As a specialized firm, we bring value from the very beginning of a project. Our pre-construction services help manage every stage of the development process, from due diligence, approvals, and integrated project planning. We have the team, technology, process, and experience to deliver. Wales McClellan is the specialized partner you need for your project. Learn what 50 years of focus and experience can do for your next build.
Good afternoon, everyone, and welcome to the webinar. Before we begin, our NAIOP Vancouver past president, Jason Kisselback, will say a few words.
Thanks, Paul. Hi, everyone. Thank you for joining us today for our first webinar of 2021. I'd like to thank our breakfast committee, which is now transitioned to the webinar committee, who've been in charge of the content for these webinars. We've had some great speakers in 2020, and they've done an excellent job coming up with new ideas for topics and speakers in 2021. Before I turn things over to our moderator and panel today, I'd like to give you some details about some of the initiatives we're currently working on at NAIOP Vancouver. Late last year, we developed a strategic plan for NAIOP Vancouver and adopted action plans for each committee. Some of the things we're currently working on are the future webinar series for the first half of this year, a mentorship program through our Developing Leaders Committee, an economic impact study to show the impact of the commercial real estate industry for Metro Vancouver and each of the municipalities, and of course, continued advocacy efforts at the 3 levels of government on behalf of the local commercial real estate industry. For updates on any of these initiatives, please check our website or feel free to contact NAIOP Vancouver. As always, I'd like to thank our sponsors for their support. Our featured sponsors for today's webinar are at the platinum level, Colliers International, GWL Realty Advisors, Oxford Properties, and Wesgroup Properties. At the gold level, BentallGreenOak, Farrell Estates, McCarthy Tetro, TrioVest Realty Advisors, and at the patron level, CDC Construction, the Downtown Surrey BIA, Rain City, and Westbuild. Thank you all for your support. And now I'd like to introduce our moderator for today's webinar and new chapter president for NAIOP Vancouver, Anthio Yuen, Director of Research and Strategy with GWL. Anthio, over to you.
Great, thanks Jason for the introduction. And welcome everybody to the first webinar of 2021. We appreciate your support. And again, I hope you're all doing well. I think 2021 was supposed to be some dramatic shift from a crazy and obviously unprecedented 2020. And while things seem different, a lot of things still feel the same. Economies are set to fully reopen. Many of us, like myself, are working from home, and many still continue to look for work. And there are green shoots. However, though, vaccines are on their way. We seem to be flattening the second wave curve. Capital markets for real estate, remain stable. And through COVID, there's also been a lot of growth in other sectors like tech and e-commerce, which are growing as a result of everything that's been happening. So with our first webinar of 2021, we thought what we would do is sit down with some leading investors and developers in Metro Vancouver and also across Canada and globally, and get their views over 3 main focus areas. The first is, what are their thoughts over the course of the last 12 months? Things have changed quite a bit pre-COVID, post-COVID, and going into today. The second one will be taking a look at Vancouver and the market from a global, North American, national context. And then third, and hopefully we get to that time, is for the most part, Vancouver remains a very attractive, desirable investment market. I think everybody internationally, locally wants to grow in this market. So how do these leading investors and developers continue to grow in this market? And how do they actually create strategies to continue to invest actively? So with that being said, let's go into our wonderful panel and going from alphabetical order, we have Derick Fluker. So Derick Fluker is SVP of Leasing and Acquisitions with Wesgroup Properties, having joined them recently from brokerage firms Marcus Millichap, which acquired Forum Real Estate Advisors in 2019. And Wesgroup, major developer in Metro Vancouver, has been in business for the last 50 years, and Derick oversees a fairly diverse portfolio across industrial, office, and retail properties. Coming to us from sunny, maybe snowy Toronto is Mark Howe, who is a director of asset management on the office side with Oxford Properties. And I'm sure many of you know Oxford is a major global institutional investment manager, manages the pension on behalf of the Ontario Municipal Employees System. And Mark will bring a unique view because he does the asset management for both Vancouver, major Canadian markets, but also does touch on North America as well. So he'll provide a good perspective on that front. And last but certainly not least is Jaclyn O'Neill, who is the Vice President of Asset Management with BentallGreenOak, again, a major global institutional investor. And Jaclyn mainly focuses on asset management activities in British Columbia, and similar to Derick, Fluker manages a fairly diverse portfolio across industrial, office, and retail properties. So again, welcome panelists. If you want to turn on your Zoom cameras, we can go from there. Wonderful. And Paul, why don't you pull up the first slide for us so we can get going on the conversation. So I think what we want to do for this first section is really take a look at the last 12 months, pre-COVID, post-COVID. And what we wanted to do for this slide is just to put up some key economic indicators for Metro Vancouver. And this is just looking at total employment, total office occupying employment, retail sales, and BC merchandise exports, just on a year-over-year basis. And as you can see, obviously March, April, May was really when things started to kind of drop, and we've seen improvement the last couple of months. And it's been a really kind of quick, relatively quick improvement over that time. What I would probably direct you to look at in the interest of this slide is total office occupying employment, still down 3%, but still relatively good, all things considered. And that represents kind of that growth in tech and digital media. Retail sales, perhaps with the flood of toilet paper hoarding and the growth of e-commerce and things like that, sales are actually up pretty well at 8.6%. And this kind of highlights just the introduction of federal relief programs, kind of how it's gone through. Paul, if you go to the next slide, in terms of how this has transitioned into the real estate side, we pulled some Canadian REIT rent collection data, and this is national. And each of the major REITs kind of report whether they're a office REIT, industrial, multifamily, or diversified. Relatively steady for industrial, multifamily, and even office, to be honest, at well above 90%. And for the diversified and retail REITs, they've also seen a bit of a climb from kind of the lows in April, May, going into relatively healthy levels at the last reporting date in the third quarter. So with that being said, maybe the first question, and I'll direct this to Jaclyn, is, what have your priorities been the last couple of months? How have they changed through COVID? And really, what's your thinking in terms of your asset level strategies?
Thanks, Anthio, and hello, everyone today. We've certainly come a long way since the start of COVID almost a year ago. Firstly, we're not dialing into a conference line 2 minutes before with the hopes of getting through, or maybe that was just me. But secondly, I think obviously the perception that the sky is falling has ended, and we see a light at the end of the tunnel, even if it's a little further out than we would like. We've gone through a steep learning curve since the beginning of the pandemic, which started with this traumatic shutdown, catching both landlords and tenants flat-footed. As we learned more, expectations were redefined through tenant transparency and landlords getting a clear line of sight in terms of the portfolio implications. Obviously the various government programs were vital to recapitalizing businesses, supporting employment, and providing income to those in need. And this has helped tenants better understand their financial situation, which also enabled landlords and tenants to start, to reach those rent deferral, abatement, and restructuring agreements, basically resetting expectations. Going forward, things have, as you said, certainly stabilized from those early days. However, kind of an underlying thing in that collections graph that you showed, in certain instances, it's overly optimistic because it doesn't account for, the restructured deals. Sometimes, those deals are percent of sales, which have eroded the net incomes at the property level. In the near term, we're focused on maintaining occupancy and supporting tenants, particularly those that are impacted by the government restrictions, to keep those good operators in place. We still have an eye on those COVID numbers, keeping our fingers crossed that things remain manageable in BC and businesses can keep open and hopefully stay afloat. But with a little bit of breathing room, we're also looking at the longer term now, starting to make those 5-year plans rather than, looking forward to just the next rent collection date, and revisit our asset strategies, based on the trends that we think might emerge kind of coming out of COVID.
Yeah, that's great. And I think that's a fair comment, how, the top line numbers tend to underscore the, specific dealings on a tenant by tenant basis. And I think maybe that's a good link into the question that I was going to ask Derick. So Derick, I mean, big diversified portfolio. I think we all have a general view of what the landlords are thinking, but for you on the leasing side, like, what have your tenants been thinking, and really how has that shifted from the initial kind of drop in activity with the first wave, going into a bit of recovery, but also going into somewhat of a bit of a renewed kind of risk with the second wave?
Yeah, so I should clarify, I've been with Wesgroup for 3 months now. So previously, so some of my commentary would be colored coming from the brokerage side, but Wesgroup has it's a diversified portfolio with tenants being institutional, government, quasi-government, where largely call it the income stream largely unaffected, and then for our non-institutional, so that would be, for the most part, our office space is mostly government or health authorities. And then or for industrial is still very strong, and for our small bay industrial, some of those tenants did struggle, but for the tenants that we did lose, those spaces leased very quickly. And we did work with all the government programs to try and help tenants, but for the most part, industrial's been like very, very strong. We do have some retail, not a lot. It's predominantly grocery anchored within master planned communities. So there's, you do have your struggles there. Our view has been to try to get through to the spring, being when the weather gets better. Last summer wasn't that bad in comparison to what we're kind of going through right now. So we do need to provide assistance, just take that not trying, basically taking a shorter term view. But I guess back to your original question, it's every tenant has a different outlook. So you can't, to give a broad statement of what tenants are thinking. It's every conversation is a little bit different. The government tenants are, health, they are under budget pressure for different reasons, and depending on what function they or what form of government or what they're doing. So they're it's not necessarily rent deferrals, but they're looking at their space requirements. So there's different conversations on that front. But I guess just by the nature of our portfolio, it hasn't been as dramatic of a problem as I would say maybe a typical downtown office landlord.
And Derick, when you mentioned the government tenants, was that more on the actual office side, or was that kind of quasi retail, or? Oh, sorry, you cut out there for a sec.
Sorry, yeah, predominantly office.
Predominantly office. Okay, great. Okay. Well, Mark, I mean, I guess maybe going to you, I think what's been interesting is I think all of us have seen the kind of the daily COVID case counts, and you kind of see the kind of bounce up and a bit of a flattening the curve. But, BC's definitely been leading that, compared to Alberta, Ontario and Quebec. So I guess for you, taking a bit of a national view, you have assets, across the board in these major cities. have you paid close attention to just the different kind of, economic, recovery rates? And then does that also affect, where your views are in terms of, your leasing, CapEx, asset strategies?
Yeah. Thanks, Anthio. So yeah, looking across Canada, it is interesting, the different responses of the government and the case counts, and maybe it's also the population. But, when last summer, the case counts were low, we did see noticeable differences regionally. So Toronto never really fluctuated much above 5% in returning to the office, but in Vancouver, it was 15 reaching 20%.
Oh, interesting.
Interestingly, Calgary was, leading actually Canada in terms of just, coming back. They were at about 40%. And of course, everything reversed come fall, second wave. And I guess everyone had to take a little bit of a more conservative approach because case counts were dramatically rising. So that was interesting. And on your other question, strategically, we're still, we do see the light at the end of the tunnel, and I agree with Jaclyn and Derick on their comments around, helping provide the bridge, right, to some of our tenants, and predominantly when we say that, it's to the retail tenants and the urban retail, because office tenants, the surprising thing about the office tenancies are we did collect, in the high 90s, and that's from March on. And so, had you asked me that in March, I probably wouldn't have guessed that, but that was a pleasant surprise in that the tenants actually, notwithstanding retail, held relatively well. Does it change our priorities? Because we're not at the end of the tunnel yet, I would say no. I think everyone's still watching their CapEx, their spending around that, and that's across the board. Whether there are regional differences in how people are treating space or coming back, I would say we're still very capital conscious. It's basically stop all capital unless it's essential, and until we know there's leasing activity and others to back it up, right? We wouldn't mind spending the capital as long as we knew that the tenancies and, it wouldn't just sit there vacant, right? There's reasons to do it, and there's the business case to support it. But otherwise, yeah, we're getting pretty tactical around, all hands on deck with helping tenants with, the relief programs, every letter of the alphabet, CERS, CCRA, you name it, right? And it's tactical in the sense that it's really help them, renegotiate some of the leases, collect the outstanding ARs. What do we do with parking? Like those were the areas that got hit, and I think we'll need some attention in 2021 for the ramp up that we're hoping to expect in the near term, or at least closer to summer.
Yeah, well, and I think that kind of redefines our views on kind of covenant and tenant stability, because you kind of just have the view that the tenants are rational, fiscally responsible and things like that, and I think during times like this, things can definitely reveal themselves. But I think even in the case of the larger tenants, and as Derick mentioned, and Jaclyn touched on as well, is the large tech companies as well. Their perspectives have changed dramatically over the last couple of months. The big banks as well in terms of their office space requirements, and there's this view that they have exactly what they want to do, in the next 12 months long term, but they have no idea. Government as well, that in terms of just the fiscal responsibility that they have to take, that's also a big factor in terms of their go forward growth discussions, right? So at the end of the day, like, it's definitely an outlook, and you hope for the best, but I think that there's still a long ways to kind of going forward, right? So but maybe with that being said, Paul, why don't you pull up the next kind of slide for kind of our next discussion. And I'm really glad, we have such a diverse group here, and especially Mark, coming from Toronto, because I think, for us in Vancouver, we tend to operate in what's known as kind of the West Coast bubble, or the Vancouver bubble. And we tend to look at Vancouver kind of on an island, figuratively and literally, I guess, for the downtown, but also somewhat Vancouver inside looking out. And what I wanted to do was take a reverse view and take a look at Vancouver, outside looking in. And I think context is important just to frame where we are on a North American basis, global basis, just to figure out where we're kind of positioned from a risk, performance perspective going forward. And this is just looking at the fourth quarter 2020 downtown office vacancy rates, as well as the fourth quarter industrial vacancy rates, across the board. And obviously with the rise of smaller sublease space in the market, some head lease space coming back up, Vancouver's vacancy rates did increase, 360 basis points year over year. But it's still relatively low at 5.8%. And you compare that to a lot of other major global or North American markets, New York, Seattle, San Francisco of the world, and it's the lowest across North America. Opposite of that, you look at industrial, Toronto, Vancouver, Montreal, and even Ottawa to some extent leading the way. But this is also off the back of a fairly, mature, robust e-commerce market in the US and even LA, New York, as much as those markets are great, like, Vancouver, Montreal, Toronto, near that 1% vacancy rate mark. So I think as much as things are still uncertain, I think Vancouver is still, relatively stable. So, with that being said, going back to Mark for your view is, what is the view of Vancouver from a global and national perspective? Just what is your views on just, this kind of small, 3 million person market in a global context?
Yeah, so you've touched on a few points there. I'll talk a little bit more upon Vancouver relative to the global stage is a great gateway city, attractive for many of the reasons we don't need to lay out. Lifestyle being the weather and everything else being at the top of that list. But it is a small market to invest in, so it's tough when we do look at Vancouver. We're bullish on it, just to be clear, but at the same time, there's not a lot of liquidity for scale. So that's one maybe difficulty. So you can look at that as a pro and con, right? That is both, the barrier to entry and whatever else is positive as well. But it has stayed attractive 100%, pre or post COVID. I don't think nothing changes there. But back to maybe the slide you pointed out. I mean, we were coming out, when I say we, Vancouver, similar to Toronto, we're coming off of a very low base. So going into COVID, we're fortunate that we were coming in at the lowest vacancy rates in all of North America, right? And so coming out of it, I'm glad to see we kind of held that position. When you look at some of the other coastal markets like New York or San Fran, they're not necessarily in the same admirable position. San Fran, the last statistic I read, Green Street, I believe last week or two, last year they went from historic low to historic high all in the same calendar year. So, it's a little bit more volatile. But that's also maybe a positive of a smaller market, not necessarily, you're not going to maybe get those wild swings there. So, the other piece I'd say with Vancouver from a global perspective, or maybe even just the American perspective and Canada more broadly, is that, the quality of life is great. The quality of tenants, especially if you're talking about tech, is amazing, right? Pound for pound with the Canadian dollar low and everything else, the quality of tech talent that you'll get up here in Canada is very competitive and much lower cost, right? So yes, you can say Vancouver expensive for this and that reason, but if you're an employer trying to grow and you're one of the big tech firms, you're looking up north, especially immigration when it was the Trump era was less friendly, and so there were a lot of those tailwinds, I think, that make Vancouver great, and that doesn't change. So yeah, I'd say it's still very, very attractive.
I certainly agree with everything Mark said. I think one thing that will come out as an additional challenge as a result of our success and the slowdown during the pandemic is, a lot of the residential developments have been put on hold during this time. And so I think, as migration picks up and, as companies look to grow, housing affordability is certainly going to be continue to be an issue in this market. Given the fact that Vancouver has also fared better in that we haven't had the same exodus to the suburbs that Toronto and Montreal has, I think that's an important factor for us to consider looking forward. But I certainly agree, definitely bullish on Vancouver if you can find the right opportunity.
Yeah, and I think that's a good point, Jaclyn, around the capacity, because I think, Mark, when you talk about those West Coast markets that are unbelievably tight, and I think San Francisco and even to some extent New York as being those leading examples, like you can be a bit of a victim of, your own success. And I think affordability, we've seen it emerge, it's definitely probably more so down south, but those issues can and could become, more prominent in major Canadian cities. So Derick, I mean, maybe shifting over to you, long-standing history with Wesgroup. You're mainly Vancouver centric. So what is your view on Vancouver? Is it still going to be the same, just kind of, growth plan for your company? Do you still see it as more of a stable play, or are you still seeing a lot of just good growth in the Metro Vancouver market?
Yeah, well, I guess, I did some research on if they're, obviously for the size of company, it's a lot of eggs to have in one basket. You could make that argument. The counter argument is that to go to a new market and replicate what we have would be challenging. We have well over 200 people who have relationships with every city, council, planning department. We have in-house construction, sales, marketing, so on and so on. So to go to Toronto and try and compete with the, best in class in Toronto, we would need to have scale to replicate what we have here. Vancouver's a great market, and we've been here for 50 years, and it's continued to get, it's been great and continue to get better. So, there's been discussions. We have had offices. There was an office with Park Lane in Edmonton. We have done an industrial development in Calgary. It's challenging to manage from Vancouver. And we've kind of come back to Vancouver. The intention is to stay, and for all the reasons that were mentioned above. It's a great market, and we have a great team here that's set up to execute. So for that, I would say we'll probably continue to focus on what we think is the best market in the country. So kind of why leave?
Yeah, well, I guess maybe off the bat, and I think Jaclyn touched on that. So let's take a bit of a kind of not a contrarian view, but a bit of an opposite view. So, we're still not out of the woods yet, over the next couple of months. So, like, what do you see as kind of the immediate risks? I think, Jaclyn, you touched on it with, the growth of tech workers coming in, trying to find them places to live. That's also a factor. You still have kind of the second wave. Maybe this is a question for all of you as a bit of a sidewall, but like, what do you see as the major risks over the next couple of months?
I think one thing you asked is a return to normalcy. And that is something I was going to say. I don't think I've ever seen it in Vancouver. I've only recognized it in hindsight. Wishing when it was $7 industrial rents and 5% cap rates, it felt expensive, and now you look back and you're like, oh my goodness, that was a bargain. So Vancouver has always been kind of a leader there, but I think we've covered, looking at the key risks through 2021, the key risks that are facing all markets. But Vancouver seems to be generally well situated to address it. I look at retail, for example, and retailers are obviously struggling across the board. But what we saw at some of our properties is that their BC locations did perform better relatively. Unfortunately, they're national retailers, so they get pulled down by the broader ship. But again, we're not an outlier there. Certainly also headwinds in the office sector. as we speculate what will kind of the trends coming out of the pandemic. But I think we covered it. We were coming from the the highest of the high in terms of strength. Relatively, we're still strong. There's certainly going to be headwinds, but obviously that's where it comes to the asset managers to roll up our sleeves and get involved with the properties and work with our tenants. But again, obviously there's risk, there's uncertainty given how long this plays out and what the continued government support looks like. But I don't see it as a relative risk compared to the other markets that we're involved in.
Yeah, for me, I'd add just one key point around supply. You mentioned it from the other perspective. It's a concern because of cost of living and what that can do for the attractiveness of Vancouver. For the office side supply, is it oversupplied is more the way I'm thinking about it because as we know, in the next few years, you're delivering, 22% of the inventory that's new, and at 60%.
We're both responsible for some of that, I think.
Yeah, exactly.
I think all of us collectively, yeah.
Yeah. So at the market being 62% pre-lease, give or take, what does that mean, and what does that mean for 2021? So I'd certainly like to pay close attention to that as a key risk, meaning what kind of momentum do we get as we return to that normal? Because as we know, like the leasing activity and the touring has ground to a halt, right?
Yeah.
But Vancouver is leading in terms of the chatter I'm hearing across the country, in terms of people already getting out, getting the calls, and relative to what I'm seeing in Calgary or even Toronto, for instance.
Yeah, I think certainly we've been looking across our portfolio at that Vancouver and Toronto in particular have those office supply challenges in the pipeline, and looking, from what I understand, and Mark, you probably speak more to this, is that Toronto has a bit more of a relocation issue where it'll be a backfilling of those lower class office spaces, whereas Vancouver generally has its new space creation. That being said, we certainly would have to maintain or exceed our historical absorption to maintain or keep our vacancy rates reasonable. So what does that look like? But you could take the counterpoint, and in some suffering markets there's no supply, but maybe that's because groups don't think they want to kind of play in those areas.
Yeah, that's correct. So there is higher pre-leasing generally with the 10 million square feet. So a lot more supply actually coming in the next 3-4 years. But I think the bigger concern are the backfills because they're large, chunky space. The banks are typically leaving behind, and they're also dated and maybe unattractive. So I'm careful around that because I think those will take longer to backfill. But yeah, different dynamics, but less concern with backfill. Last I looked, Vancouver, there was about 500K that had to be backfilled, so not as big a number.
Yeah, I mean, I guess from that, we talk about just the growth of tech, and I would probably highlight that as Mark, you mentioned, kind of the shift in administration, and we continue to be a relatively affordable market, all things considered. But I think there definitely are risks to that side as well, because you look at just what is the extent of tech growth. Obviously that's a little bit unknown at this point with everything that's been going on. But I guess the only other green shoot about that is that as you mentioned, there are differences in tech markets across major Canadian cities, right? With fintech and health being more definitive of Toronto, and AI and gaming in Montreal, and then more digital media out here. So hopefully those green shoots will local green shoots, I guess you could say, will hopefully kind of navigate that potential policy risk if there's a change in immigration and labor and things like that. So well, with that, maybe why don't we go to what I hope is kind of the last slide, but definitely a lot more kind of discussion to go through. And I think what I really wanted to highlight was the fact that I think a lot of the early on distress that I think people have thought in terms of capital markets with real estate didn't materialize. I think number one, there wasn't a lot of deal activity. The rent collections were relatively stable. Government, really came in to help stabilize things. And even more so, I mean, I think there was a report from Preqin that highlighted that there's, several $100 billion of global dry powder for real estate. Didn't really change that much post-COVID. A lot of major pension funds, institutional investors want to increase their allocations to private real estate. And this slide just highlights just the breakdown of market cap rate. And I made estimates just because, there hasn't been a lot of transaction volume to provide transparency in terms of actual pricing, but this is what is kind of from surveys or from research groups. Again, Vancouver, low really, across the board. And even just for the major Canadian markets on a comparative basis. And then on the second chart on the right, looks at the greater Vancouver area investment volumes. And this is the second half of 2019 compared to the second half of 2020. And, everybody had mentioned just the drop off in volumes, and that definitely is the case. But, we wanted to break up the differences between the $10 to $25 million mark, because that includes some of the kind of, strata, some of the smaller properties down 13% only, but it's really that larger segment, $25 million plus, that has really dropped off. And I think, the stat that we've seen across the board is just the 50, 75, $100 million deals. Historically have always been pretty low, in Vancouver, but even more so through COVID. So, maybe my question is, and this is probably the more complex one, and we'll start with Jaclyn, is how do you grow and invest in an increasingly small competitive market as Vancouver? Do you take a more broad-based approach, looking farther out, looking, across the province? Or do you take a more market, micro market approach? And maybe I'll ask Jaclyn, and then maybe let Mark and Derick also provide their perspectives.
Yeah, fortunately, we already have critical mass in this market. So, looking forward, we're really going to be targeted towards refining our allocations and picking product strategically as long-term holds. Unsurprisingly, it's focused on growing our multi-res and industrial portfolio. I know I'm blowing people's minds here.
Yeah, exactly.
But like everyone, we are underweight, and and definitely looking at that. We'll look to adjust this through strategic allocations. We bought that Campbell Heights land a little while ago that we're developing. We're also doing infill developments at our existing properties. We just completed our new Viridian project, which is a purpose-built rental apartment building at 14th and Burrard that we're currently leasing up, which was on an existing property that we owned and had an older building on, and we've added there. We've obviously are also developing our B6 office project downtown. Yeah. We're going to continue to look for opportunities to deploy either through redevelopment of existing properties, our build to core strategy. We still believe in core assets, and in the long term are going to be the best ones, the most resilient ones coming out of this, or purchases of good quality income producing assets, or near term development, looking at those forward purchase opportunities. So obviously, to friends in brokerage that might be listening, there's our list, and we look forward to any ideas that you might have.
Maybe Mark?
Yeah, I would echo a lot of those. I think, just broadly speaking, you got to be maybe more creative in how you think about it, and maybe going up the risk curve a little bit, because of the competitive pricing, i.e. it's expensive. So to justify paying those prices, you really got to get comfortable around, value add or developing the core, as Jaclyn said. And, fortunately, we do have that in-house capability, so we're comfortable, doing projects like that. And, one example, even, where you maybe are land constrained, can't find land, you build up, right? Like our Riverbend Business Park in Burnaby out there, we decided to just do a multi-story industrial. So that's what I mean by creative. You just got to do different things to look for value.
And Derick, maybe, on your comment, other small BC cities, is that also another factor that you guys are taking a look at?
Yeah, probably not. And the main, and I have a kind of a long history in working in the secondary markets of BC through retail, or with my retail background. And I guess just the nature of Wesgroup, our income producing portfolio is quite conservative in its tenant mix, and it's largely kind of set up that way or designed that way to offset the risks we take with development, where we do take risk, like substantial risk. With the strategy being that we've got that safety net that's there to offset the risks we're taking. But we've never really been heavy into retail, and the only decent covenants you're getting in the secondary markets is generally retail. And industrial and secondary markets is generally pretty small and mostly local, and same with office. So I would probably never, potentially a larger mixed use community in maybe Victoria or Kelowna, but not an area of focus for us.
Yeah, fair enough. Well, I mean, I guess, going back to Jaclyn's comment around the kind of the beds and sheds, phenomenon. Like, I think what we've seen is that there are contrarian views on office and retail, and as Derick mentioned, I mean, some of the secondary markets and grocery anchored has done fairly well. So, is there a arbitrage opportunity in the future for office and retail? Is it here today? What are your thoughts on that?
So with retail, it's not going away, and it's certainly not. A lot of people there's an opportunity, and certainly in the Lower Mainland with the development sites. And if you want a 10-acre master planned community anywhere in the Lower Mainland, there's a high likelihood it's currently a shopping center.
Yeah.
The challenge with that is the leases and the no builds, and and just trying to get at that land is not an easy task. So you're actually seeing, because of how challenging it is to develop those sites, you kind of hear a mix of cap rate and buildable quoted in the price. So it takes so long to get it approved that in some cases the leases might burn off by the time you can actually start building anyway. But there are opportunities there. But no, I spent 15 years in retail, and restaurants certainly are having a hell of a time right now, and that's no surprise. It's coming back. I'm desperate to go back to restaurants. Like, I wish we could have met for a beer for these meetings. I hate Zoom. So yeah, it's coming back. It's definitely coming back. Your big box retail, some of that will stay on Amazon. People will continue to shop on Amazon. That's a reality, but that's a small percentage of retail. Retail is several different segments. Retail gets painted with a broad brush, but it's restaurants, it's nail salons, hair salons, like experience, all these different things. But it's really, maybe 10 or 15% that's largely or majorly impacted by the internet. So is there an opportunity? I think there is. I just think until the banks will finance it, but like that needs to sort itself out. And I don't know. I think people are probably going to, until it's properly discounted, you won't see a lot of trades for the balance of the year, is my prediction.
Yeah, fair enough. Yeah.
Yeah,
Well,
I don't see. I was going to just add quickly that there's still a big spread, perhaps, just different expectations. So the bid ask spread, like the vendors versus what people are wanting to buy to take advantage of that contrarian view. I don't think you're seeing it, right? And maybe retail, maybe if you pick retail specific to like Alberta, maybe, there's deep value there for a really contrarian type investor. But, if you say, I think it's still too early to say that for office, right? Even in the more challenging markets, across North America. So I know I would maybe think of it as if you had an allocation for office that you still needed to fill, I mean, I would maybe look at it more geographically. I would say, where are you better off putting that next dollar? Is it here or is it like in Asia Pac or something like that, right? So I would look for those opportunities versus, so markets more than it is maybe the classes.
Yeah, and Mark, I think that's a really good point. About just the mobility of capital, I guess you could say, because there's, obviously you have a mix of different, investor groups. Some are more local and some are more global. And I think, for Vancouver, it's becoming increasingly competitive in a global marketplace for capital, right? So I think so far, as you mentioned, all the key things around livability, barriers to entry and things like that have made the market, why it is expensive, right? But again, there are also lots of other opportunities in other markets. And, I think what's interesting is when you talk about Vancouver, you have, 1 3 million or 2.6, metro region. In the US, there's probably 10 of those. So when you talk about the movement of people outside of New York into the other markets, they have 10 Vancouvers to choose from, where, in Canada, you just don't have that scale of cities, because the next tranche, as Derick had mentioned, like Victoria, Okanagan, those are a couple 100,000 people, right? So, I mean, maybe in a follow-up, we touched a little bit on the different asset classes, and I wanted to kind of dig into it a little bit, further. But Jaclyn, say for your group on the industrial side, we all like beds and sheds, but I think the dialogue is more around different asset classes than within the asset class. So maybe for your group, how do you think industrial is changing within Metro Vancouver?
Looking at
geographic shifts or different building types that are starting to emerge.
Obviously we're exploring all of that. We have a pretty solid existing industrial portfolio located across Metro Vancouver. Some of that is closer into Vancouver, so ideally positioned for that last mile delivery, and we certainly see that strength at those assets where rents have literally doubled probably within the past year and a half. Thinking of areas like North Richmond and that sort of thing, assets that maybe are aging and I would have thought would warrant redevelopment in the near term. Now it doesn't seem to be like there's any pricing differential between that and new product. So you're not going to see a lot of redevelopment if those rates and that strength remains elevated. Obviously logistics, large bay, warehouse, we're very bullish on. We see good demand for it. That's buoyed by our high cargo numbers coming through the ports, given Vancouver's unique geographical location. But Vancouver's not the destination for that product. It's typically it's more of a transit hub. So if that stuff starts getting routed through other ports or back down to the States, that could have a ripple effect. But that being said, it's I think we talked about it a little earlier. For are we looking at niche plays or market plays, and industrials maybe a little bit one where old boats are rising a little bit, we'll see where that goes. But it's it's hard to see how that's going to significantly change given how low our vacancy rate is, and that I don't see significant new supply coming to the market. Something we've been saying for 10 years, but it still holds true today, if not even more so.
Well, it's funny, right? I think the niche play comment is interesting, just because you know that there's this whole dialogue around last mile and kind of that rise of like inner city industrial. But on the flip side, like our team had pulled some stats looking at just population growth, and obviously if you're looking to have a strategy where you're getting goods to population, I mean, the Fraser Valley has been growing tremendously, right? So in the case of Derick, and maybe this is a bit of focus on your existing portfolio for Wesgroup, like Surrey has a lot of you have a large portfolio in Surrey, especially on the land side. What's your views on kind of the growth of your industrial portfolio, or are you guys looking farther out east, or is it still going to be central to just kind of your core portfolio?
Well, it's absolutely building out our existing land, and similar to Mark, it's hard to find more land. So what we have been doing is trying. We do have multi-level industrial coming that we will be starting construction next year. It'll be about 140,000 square feet with basically large, just over 100,000 square feet on the main level, and then small bay on the second. And when you look at the cost, it's obviously more expensive to build, but we're looking at that 40,000 on the second level. The additional cost is similar to what the cost of the land would be. So the incremental increase to the construction cost is similar to buying the land, but you just can't get that land. So it's so that increased density is similar to buying more land. So we're actively looking for land, but we're trying to make better use of the land we have, because of how hard it is to find more sites. And that's City of Vancouver. We have industrial sites. We're looking at one that's I guess it's 3 levels of industrial and then 2 of office. And the logistical challenge of getting goods in and out of that building, it's not easy, right? So for the user, so there, how it'd be interesting to see how users react to that level of density versus just driving further out to the burbs.
Fair enough. Yeah. Mark, do you have anything to comment on, or you're good? Oh, I think you're on mute there.
Yes, sorry. Yeah, for us, I think industrial in Canada, we have a bit of a different strategy than how we approach it worldwide. Globally, we would look for more platforms to get the scale. We don't have the local expertise per se, so we bought into the IDI platform in the US. A couple of years ago, last year, we took a significant a stake in a company called ESR in Asia Pac, and we took, they went public on the Hong Kong Stock Exchange of all places. So that was a great opportunity because that's run up really well. But in Canada in general, we do more of because we have boots on the ground here, we definitely do more of the approach like source and build, and it's more like a one-off strategy as opposed to a big deployment.
Got it.
Allocation. Yeah.
Well, I think we're getting close to the end in terms of kind of the main questions. So maybe we'll do kind of like a rapid fire round if we're okay for it, and I might throw in some kind of curveball questions here. So maybe the first one is maybe it's property values, or maybe you want to comment on asset class specific, but up, down, stable next 12 months.
Fire away.
Who's drawing the short straw there?
Mark looks like he's ready to go, so why don't we ask Mark? So.
All right. What's up? Sorry. Oh, up, down. Like you want every asset class? Sorry, miss.
Per view, yeah. Maybe the main ones, the main 4 food groups.
Industrial, gosh, a little bit more up. Office, side to down, depending on markets, of course. Everything is caveat with specific markets. retail down, and multi. I think we'll be sideways for a bit.
Fair enough.
You literally said everything. we're definitely in line there. You know, I it's I do think there might be a bit of weakness in the office as we kind of try to find where those stabilized incomes will be. And although we're obviously bullish in multi-res, there are some headwinds there in the near term with our incomes, which might offset the gains from compressed cap rates. I think industrial will be up definitively. So yeah, definitely in line.
Okay.
If I can add two things, maybe.
Disclaimer all over the place.
yeah. Like, there was a surprising trade. Bay Adelaide North here in Toronto. It's a AAA class, fully let, brand new building. And the rumor last week is that, it is transacting at, very healthy numbers. It's in the low 4 cap number range is what I'm hearing, and $880 per square foot. Like, that's amazing for an office, like you in a challenging time, right? And to be transacting or recapping. So anyway, I thought that was interesting. And the second point around, maybe what surprised me about multifamily is that, the ones in the CBDs were the ones that got hit the hardest. You guys, we all kind of talked about the migration out of CBDs, and that was one cause of it. But that's what made me kind of, hedge against, like, where's multifamily going? Sorry, Derick, your turn.
I think it somewhat depends on what the Bank of Canada does, right? Interest rates are so low right now that it wouldn't, if they, obviously, that they somewhat control asset values. So if interest rates are up 50 basis points, you could argue that's going to have a material impact on all asset values. I tend to think that if there's a few large office transactions that seem to indicate that stabilized incomes are going down, that's going to have a negative impact on office. Industrial is definitely going up. We're seeing it in our industrial portfolio. Just the rates are, all types of industrial rates are going up. Multifamily, it depends on CMHC. Like the types of CMHC financing out there, there's so like it depends on those programs. So I preface that with, you need an inside track at CMHC.
As well as the Bank of Canada, right? So well, I think we're hitting the 1 o'clock mark. So thank you again for the perspectives. I really appreciate the time, and then for everybody that dialed in, also again appreciate it. I think it's important for us to stay connected through a virtual environment, and then hopefully as we move along in the year, we can, hopefully see each other, in a virtual environment or perhaps physically. But have a good rest of the day and rest of the week. And we will definitely look forward to seeing you on our next panel coming up next month. So thank you very much again, everybody. Have a great day.
Thanks, everyone.
Thanks, Anthio.
Yep.
Thank you.
Yeah, thanks.
Thank you.